Hello everyone, I'm Joel, your host for Talking Trends, where we explore trends in real estate and other luxury lifestyle elements here in the greater Sarasota area. Today we're excited to have Scott Kolbe with us to talk about mortgage interest rates and what's going on in that market. Welcome, Scott.
Thank you, Joel. Thank you for having me.
It's the second time, so we're very happy to have you back. It was almost not quite a year ago, but
Right.
mid-2022 when we spoke last. And I think, of course, we want to have an update on what's going on in the mortgage market, but maybe best to just address the elephant in the room.
Right.
We've had some recent bank failures, and obviously that is something that's out there and on everybody's mind. Can you kind of
Correct.
just
Sure.
give your debrief on it?
Absolutely. So it's very, very important to recognize that this incident is very much different than 2007, where we saw more widespread bank crisis and more widespread bank failures. 07, really driven by debt, not good lending practices, bad debt capacity, and all of those practices. Fast forward to recent activity, most significantly Silicon Valley Bank, really is asset purchase, what they did with their deposits, how they invested those deposits. And then when that run started, it created more loss, and really was down to mismanagement and honestly poor communication. But if you look at the health of banks, you are not going to see a bank failure rash that we had in 07. You're just not going to see that. A lot of banks are testing positive on liquidity. Loan capacity is good. Loan quality is excellent. As the consumer will tell you, what we put them through to qualify for a mortgage, very, very demanding, but it equates to high performance.
Yeah.
So we're not going to see a rash of bank failures. The market has already told us that. If you look at what's happened even in the last 48 hours,
Right.
with the rallies and then the rates kind of stabilizing. So the market's understanding that this is not going to be a major crisis, and it's isolated to those banks.
I mean it's excellent news, and I think it's on everybody's mind, right?
Sure.
That's the kind of flashback to the recession and what happened there. I think we even see it in the real estate market. It's different. The buyer mentality has changed, and there's a little nervousness that the fundamentals have shifted. But I think the reality, just like you said, our buyers are end user buyers. They're not investors. Loan lending is more solid. It's onerous to the borrower, so it's just a different world.
Right. If anything, it had a positive impact on interest rates because the instability in the market caused some flight to quality. Rates kind of chased down a little bit and got us back into the low 6s and high 5 range in some cases. So if anything, it was good for the consumer. It kind of settled the feds a little bit and forced their hands on hike. So if anything, it had a positive impact on rates. And then already you see the market's really recovered, and bank stocks are doing well. That would be your first indication to issues is plummeting bank stock, which you don't see happening. So the consumer should not worry about it. And we really feel optimistic that this is not going to be a bank crisis widespread more than what's happened.
Awesome. We'd love to see if we can take that one off the list.
Yes. Yeah, take it off.
But talking about the Fed and what they're doing, I mean, they still are proposing hikes, correct?
They are. So just in the last 48 hours, we saw a 25 basis point rate increase. But it's important to know that the bond and mortgage rates are very sophisticated and move on speculation. So a lot of the pricing is built into what the feds are going to do. So actually rates went down with only a 25 basis point increase because what was baked in or built into the current yields. And what's really important is what the Fed said in their posturing of hinting to this is going to begin the easing of these rate hikes, which is really the first time they've been that strong in commentary, and the market reacted very, very favorably to that.
Right. Again, I think, counterintuitive, but those kind of recent hikes have actually pushed rates down a little bit. And like you said, I think the key for people to understand is it is speculative, right? And they are anticipating what the Fed's going to do well in advance of what it does.
That's right. That's absolutely true. The bond market moves in speculation to that and builds in what they believe the rates are going to do based on the Fed posture. It's pretty interesting.
Yeah. fascinating. Again, slightly counterintuitive, but very interesting. And obviously for our market, real estate, it's really all positive, right? We are seeing pressure on rates, going down. So just maybe kind of a brief overview, where are rates today and kind of where do you think they're going to go in the next, say, 6 months?
Yeah, so like I said, rates are in that low 6 range to high 5% range, depending upon the day, depending upon if it's a long-term adjustable rate or the traditional 30-year fixed rates. And they've been very, very stable over the course of the last couple weeks with some ebbs and flows. Certainly with the Fed posture of easing rate hikes, that will allow stability into the mortgage market, and that will allow rates to come down. If you look at the 10-year Treasury yield, which is typically what mortgage rates price to, plus a margin, right now that margin or that gap is much larger than 20-year historically, which tells us that it's instability, which tells us the market just isn't stable for mortgage rates because they just don't know what the Feds are going to do, where rates are going to go. So with the Fed movements and the Fed language and the Fed goal, if that will create stability, you'll see mortgage rates turn back down because that gap will become more realistic. We'll follow historic trends and mortgage rates will come down. The markets don't really have to improve, meaning yields don't have to come down, rates don't have to come down or be lowered for mortgage rates to come down. We just need stability.
Okay. Yeah, very interesting. And again, I think it's somewhat counterintuitive because we're all watching the Fed, right, and whatever they do, but it's not necessarily what dictates what mortgage rates are.
That's correct. It's all based on the market perception of stability and how that impacts rates. That has the biggest impact on mortgage rates right now.
Interesting. Yeah. Awesome. So just maybe snapshot jumbo 30-year jumbo with an ARM.
Jumbo 30 years in the low 6s. Jumbo ARMs are in the high 5s. So very, very good still, very affordable. We've yet to see mortgage rates impact affordability, which is good. But we still do see a lot of activity in the ARMs, and that's something that consumers should really look at, is those long-term ARMs, knowing that rates are going to trend down. If they can take a product that has a shorter term, but yet a lower rate, and buy them that time till we get back into a more stable refinance market, it's wise to do that.
Yeah. And again, I know crystal ball, but more stable. When do you predict that will be? We feel more optimistic about it today than we ever have, just based on the commentary. And if you read through that dialogue, there are absolute hints and absolute posturing that these rate hikes are slowing down and that the Feds do want to eventually stop that. They actually forecasted out, the next year beginning to lower rates and ease that, which of course have a significant impact. So that commentary alone leads us to believe that, over the course of this year, we'll see stabilization. And then hopefully as we get into next year, rates really kind of trend down. Awesome, fantastic. So great. I think it's really interesting information. Again, I think we addressed that kind of elephant in the room right off the bat because I think it's really important for the consumer to know about that and how it impacts the real estate market. Anything else that we should be thinking about as we look into the second half of this year or next year?
I don't think so. I think it's just keeping an eye on rates and inflation. When we're in and out of the recession and looking back at all of that detail. I think that's really what all eyes are focused on through the course of 2023 is recession. When is it over? How deep is it going to be? What's the landing going to be? And then what does the Fed have to do to pull us out of that? Obviously, the deeper the recession, the more we're going to have to get aggressive in cutting rates versus a softer landing. The Feds can ease back into lowering rates. So that's really what we're watching. Certainly the emergence of interest-only products that are coming out that we'll have available for you will be fascinating. And then as the mortgage market gets stable, I think we'll innovate, more and better product for the consumer.
Fantastic, and I think I'll just throw my little tidbit about how it all impacts the market. Obviously, the real estate market here in Sarasota continues to be incredibly strong. I think a lot of our buyers are not even borrowing to buy, which is a wonderful thing, but I think it all plays on the psyche of
Sure.
the buyer. And so again, as we kind of explore this more and we know that rates are trending probably down, it just helps the psyche of the buyer. So again, we anticipate the markets continue to be very strong.
Yep, absolutely.
Awesome. Well, Scott, great to have you back on the show. We appreciate it, and I'm sure we'll do it again soon.
Yeah, thank you for having me.
My pleasure. Thank you again for joining Talking Trends. We look forward to the next segment.